So the next topic that we are going to learn is audit of leases. In this topic, we are going to specifically learn about IFRS 16 leases, which is specifically created for the lessee accounting, and how we are going to audit the lessee accounting as well as the lessor accounting is what we are going to learn in this. But the complication is more for the lessees rather than the lessor. So your focus will be majorly on the standard IFRS 16. IFRS 16 is something that you would have learned already in your financial reporting subject, your strategic business reporting. So I'm not going to give you a big detailed explanation about IFRS 16, but let's quickly summarize what is IFRS 16, what is lease contract, and understand the particulars about the standard before we learn how to audit this standard lease contracts. So IFRS 16 leases, okay. So what is a lease contract? Leases have two parties, okay. One will be a lessor and another will be a lessee. Lessee will give lessor an asset for the lessee to use it for a specific period of time. So there will be a n period of time, number of period, okay. In return, lessee will pay lessor every year, okay, lease payments, okay, for the same period. Now, as per IFRS 16, which is specifically for the lessee, okay, but this particular contract where lessor has an asset, who's the owner of the asset, who have purchased the asset and has given lessee for him to use it for a specific period of time. In return, lessee will give him back, the lease payments for using the asset every year. This is called as a lease contract. Very simple, right? Very simple. But in this particular contract for lessor, he has to recognize, okay, this contract into two categories. You have to recognize this contract into two categories. One is either an operating lease, or he has to recognize it as a finance lease. Now in operating lease, what happens is that the asset, even though it is lessee who's using it, okay, even though it's lessee who's using it, the control of the asset will be with the lessor. So control will be with lessor. Okay, that will be with lessor. That is called as operating lease. Whereas in finance lease, the entire control of the asset, will be with the lessee. That's the number one differentiation between operating lease and finance lease. In operating lease will be for a maybe a short period of time, shorter period than compared to the life of asset, but this will be substantially equal to the life of asset. Okay. Now when it comes to operating lease, this lease payments will be directly to the income in P&L, okay, and asset will be shown in statement of financial position. Whereas in finance lease, this lease payments will not be shown in income, but rather it will be shown in receivable, okay, in receivables, and asset will not be shown, will not be recognized. So you will show a lease receivable in the asset and the lease payments will be shown as a receivable, and there will be interest on lease, which will be lease payments that will be taken to your finance income. This is how finance lease are categorized. So nothing complicated here. It's something which has been happening for quite long period of years. So there is nothing complicated that we need to understand. But the complication comes when IFRS 16 comes into the picture. Okay, IFRS 16 comes into the picture. So IFRS 16 says that, okay, which is specifically for the lessee accounting, The lease can be divided into two categories. Okay. One is short term or low value lease. Low value lease. The others are all other leases. All other leases. So short term are less than 1 year. Less than 1 year. Okay. Here the lease expense, okay, for the lessee it will be lease expense. So the lease payments will be directly to expense in P&L. Okay. But here all other leases, there have to be created, okay, two things. One is ROU, a right of use of asset. Second will be a lease liability. So ROU is called as the right of use of asset. Okay. ROU is called as the right of use of asset. Why? Because in ROU there will be control of asset to the lessee. So control of asset to the lessee. So what is the control of asset to the lessee? Let us say for example, you know, I am Prashant, okay. I have a vehicle with me, okay, and I gave it to my friend Rahul. Okay. I have a vehicle. Let's say for example, I have a car. I gave it to my friend Rahul for a period of, okay, let's assume for a period of 5 years. So 5 years I told him you can use it, and in return you have to pay me every year, $5,000. Okay, 5,000 per year you have to pay me. Let us assume this way. Okay, it's a simple example. Now Rahul is saying, okay, if the car is damaged, okay, Prashant will service it. If the car is damaged, then Prashant has to replace the car, replace with a new car, etc. Now what is the situation here? So Rahul is just using the car, but he is not owning it. It's not his. He's just, in paper, it's like we have given to Rahul. In legal form, it is like, okay, we have given to Rahul. Rahul can use the car. But in substance, if something happens to the car, it's my responsibility. I have to give him another car. So here, whenever in IFRS 16, it's a judgment term where you have to go for substance over the legal form of the transaction. Legal form. So just because the legal form says that Rahul can use the car, so he has the control over the car, doesn't mean the substance will be the same. So in contract, there will be situations which will call out the substance rather than the legal title as if Rahul has everything to use for. No. Substance might oversee the form and say that there is no control for Rahul. So here in this situation, there is no control. There is no control. No control over the car for Rahul. Because the car which we are given is being replaced with another car. If it is damaged, Prashant is servicing the car. So Prashant is the one who can take all the call over this particular car. That's not a proper lease contract. It will be termed as other, low value or a short term lease. In this case, there is no control. There is no right of use of asset. But if the lessee here, who is Rahul, okay, and here the lessor is Prashant, if Rahul needs control, then he has to take the entire ownership of the asset. The entire ownership of the asset. Entire ownership of the asset. Now what does that mean? Rahul can decide, okay, Rahul can decide how he will use the car. Use it. He can use it, for his dropping his children to home. He can use it for his personal use, or he can give it to his driver and ask him to do whatever he wants to do with it. He can ask his driver to take it to a for Uber and go and ride it in Uber. So he has the direction to use it. Rahul have the direction to modify, okay, the asset according to his suitability. He can modify the car. Okay, if the car is needing some upgrades, he can do the upgrade. See, the control is given to Rahul. You are giving an asset to Rahul, means if Rahul is owning the asset, then Rahul has to act as if it's his asset. Then only there will be control over the asset. Only then you can say that there could be ROU, right of use of asset. So Rahul in his books can recognize this car as an asset, and for the payment of $5,000 per year, he has to recognize a lease liability. And this will be based on the present value of lease payments. Lease payments. Okay, present value of lease payments. So the complication IFRS 16 is based on this category. It's a substance over the legal form of the transaction, which means the lease contract have to be detailed and reviewed to establish control for lessee. So the lease contract has to establish a control for the lessee, and in the contract, if it is something is mentioned where it says that the lessee does not have primary controls over the asset, then it's not a lease contract. I can give you a real life example. When I was auditing one of a company which is based in Middle East, the company had taken a rental of their garage. It was a parking space from a building. They had taken a parking space. It's a big parking space they had taken. Yearly they were paying some rental income, and it was for 5 years. So just because the lease term is greater than 5 years, okay, it doesn't mean that we have to create a ROU or a lease liability. Yes, there could be case of, yes, if it is more than 1 year, you can show it a ROU and a lease liability. But the question comes, what is the substance over the legal form? In that contract, it was very clearly mentioned. It was very clearly mentioned that the lessee does not have primary controls over the asset, which means lessee can use the parking lot, but only for the purpose which is defined in this contract, nothing else. Which means there is no control. Why? Whatever is mentioned in the contract, he can only use it for that limited space. But is that how the control will establish? If you have a control over a machinery, you can do whatever you want with it, right? If you want, you can throw it away into the ocean. If you want, you can use it in your office. If you want, you can sell it to someone else. You can do whatever you want with it because you have control over that asset. But if an owner is saying, the lessor is saying, see, you can use this asset, but you're going to use it only for parking space. You cannot put let's say, shutters in that and give it for a shops for rental. No, that you can't do. That's not a lease contract. It's a normal rental agreement. So you need to divide, when it comes to substance over form, you need to establish the control. You need to establish the control over the asset for the lessee. So the lessee should have the control over the asset. Only in that case, an ROU can be created. Only yes, then ROU can be created. It will be a lease as per IFRS 16. Else, it won't be a lease contract. It will be normal rental contract. So this example that I told you, since the lessee did not have primary control over the asset, it was considered as a normal rental payment and the lease payment was taken into expense and there was no ROU asset being created. Now, if there is IFRS 16, as per IFRS 16, if there is control and lessee has control over the asset, then what happens? Now, as I told you, there will be ROU and there will be a lease liability that will be created. Now, in ROU will include cost. The cost will be firstly the present value of lease liability, future lease payments. I would put it as present value of future lease payments. It should also include plus any other cost minus any discounts given. Discounts. Then this ROU have to be depreciated. It have to be depreciated. Okay. What will be the useful life? Right. So depreciated over a useful life which is shorter of the lease term or the actual useful life of the asset. Okay. Then when it comes to lease liability, you have to calculate the present value of lease payments, for which the present values you will have a discounting factor. And the lease payments could be either in advance or in arrears. Depending upon whether it is advance or arrears, the liability might change. And also you have to calculate the implicit interest of the lease payment. So implicit interest rate you have to calculate, you have to identify, and an interest rate have to be charged. So there will be unwinding of the discount because you are calculating the present value of liability. The discount factor will be based on the implicit interest rate of the lease. And the lease liability have to be divided between the current liability as well as the non-current liability. Okay, so a current liability and non-current liability have to be recognized. So current liability, if it is advance, then your current liability will be equal to the actual lease payment that you're going to do immediately. Lease payment, right? So your current liability will be equal to your lease payment. If you're doing your arrears, then your current liability will be equal to, you have to calculate it. How will you calculate it? In terms of arrears, you can calculate the non-current liability. So in terms of arrears, your non-current liability will be equal to your lease liability as of the next year, So whatever is your lease liability by the end of next year, that will be your lease liability, non-current liability. And if it's case of advance, then that have to be calculated. So if in non-current liability, if in arrears, you can calculate the lease liability, which is the liability as of next year. Then when it comes to arrears, it will be very simple. Your current liability will be equal to total lease liability minus your non-current liability. And in non-current liability, if it is an advance payment, then your non-current lease liability will be equal to total lease liability minus your current liability. So this you need to refresh. So it's very simple, nothing complicated. You just need to remember these concepts because it's very important. Sometimes you have to think over it, the accounting treatment, only then you'll be able to audit them. So now if you think of the accounting concepts itself, you will know what are the documents or what are the data that you need. So definitely you need the lease contract, right? So you need the lease contract. You would need to get judgment. You need to identify or judgment over the interest rate on lease. Okay. Then third, you need to calculate or I would put it as recalculate the present value of lease liability. 4, ROU of asset. Then 5, you have to review the disclosures, etc. So these are the evidences that you are supposed to collect when there is a lease payment. Majorly, you have to review the lease contract for what? To establish control and to see if it is as per IFRS 16, whether it is a lease contract or not. You need to establish it. So in lease contract, you have to read it very clearly and see if the contract is in term a lease or not. That has to be established very clearly. So in terms of the disclosures, what are the things that have to be disclosed in the notes to accounts? Let's look at here. The disclosure should include depreciation charges and the carrying amount of ROU held at the reporting date, interest and expense on the lease, like what is the implicit rate of interest and what are the expenses on lease liability you are going to calculate that have to be reported, gains on losses on the sale and leaseback transactions, expenses incurred on short-term or low-value leases, total cash outflow for leases should also be mentioned very clearly in the disclosures. If these disclosures are not present properly in your financial statement, then it is not appropriate. They have to be reviewed. So let's look at an activity number 5. What would you consider to be the most significant audit risk for leases? How would the auditor respond to some of these risks? Okay, these are the things that we need to establish. Now, even though it's like a risk and response question, it's included in chapter 8 because the responses are the same as the procedures you're going to do. So your audit responses are equal to the audit procedures you're going to do. That's how we're going to respond. How we respond to the risk? Basically by saying what are the procedures we're going to do. So that's what we are required to explain. So let's try to look at the answer for this. I've already created an answer, so I'm just going to explain those answers that I have created. So let's look at this activity number 5. Okay, so activity number 5, we're gonna explain the risk of leases for the lessor as well as the lessees. For lessor, it's a much more simpler, as I told you. It's a two-way treatment, finance lease or operating lease. It's clear cut. But for lessee, it becomes complicated because of IFRS 16 regulations. So for lessor, the question is, the risk is whether the lease should be operating lease or finance lease. So the treatment is completely different when it comes to operating lease and finance lease. Because one, we have to de-recognize the asset in finance lease, whereas in operating lease, we have to show the asset, but the lease payment will be expensed off. So the treatment of lease payments will vary and the asset will also, the treatment will also vary. So it will be, it have to be differentiated between the finance lease and operating lease at the very inception itself and have to be clearly explained. For lessee, it's far more, the conditions required are far more superior. So firstly, may not be factually a lease conditions are not satisfied as per IFRS 16 and are incorrectly recognized. So the lease might not be actually met, but still they would have recognized it as a lease because they can show an asset, right? So the asset will increase your increase your balance sheet. Even though you are having a substantial liability, you are showing an asset as well. But the situation would be that the contract does not allow you to show a lease because the contract specifically have certain conditions which are not met. To give you an example, lessee do not have right of all economic benefits from the asset. So definitely they cannot show it as an ROU because asset is something which will generate economic benefits for the lessee. Asset could be substituted by the lessor. So even then, there is no ROU. You cannot recognize an ROU. The moment you enter a contract, whatever the asset you are using, that is the same asset that the lessee have to use and recognize. Lessee do not have right to control, like lessee does not have any control of the asset, which are included in the lease. The conditions of ROU may apply, but may have been ignored. So ROU conditions are there, but maybe it's ignored and they did not recognize a lease contract. So the contract also, when it comes to recognizing ROU in asset, it's very clearly mentioned in IFRS 16 that the cost of the asset and cost of service of the asset should be separated out. Like in IFRS IA 16, we have an explanation that capitalized cost and maintenance cost. So capitalization cost have to be capitalized into financial position. Cost of maintenance have to be expense. Similarly, for ROU as well, whatever the present value of lease liability plus the cost you spend to create the asset into a good condition, only those costs can be recognized. Service cost and others have to be expensed off. There could be incorrect treatment due to this, where it could go wrong, right? So the treatment could go wrong and the balance sheet and financial statement could be incorrectly treated. Then comes the initial recognition of the lease liability, right? The present value of lease payments not yet paid, the discount factor used are not correct, penalties are not shown correctly, uncertainty, the lease implied term or the agreed term or the implied term are not correct. So there could be mistakes in terms of the lease liability being recognized due to some incomplete or inaccurate information that we have. That could be one of the issue. Like lease assets may be misstated due to failure to correctly account for any of the following as well, like initial fees and other charges which may have been ignored. So initial fees and other charges which you have spent for the asset can be recognized as the ROU. Impairments or revaluations. So since we are recognizing ROU, the asset should be classified for, asset should be tested for impairment, and revaluation should also be recognized. Dismantling and restoration cost should also be recognized, similar to that of IA 16, right? And assets may be treated as short-term or low-value leases, and there could be inadequate disclosures as well, due to which the lease contracts or the lease transactions could be inappropriately recognized. Then comes the complication of sale and leaseback. So in sale and leaseback is a transaction where if I am a company and I own an asset, but I am in need of money, I would sell my asset and lease it back so that I can get some money from the buyer and use it in my business, but I am also using the asset. So likewise, my I've got some cash flow. It will improve my cash flow. But when we sell an asset, there could be a gain or loss created, right? There could be a gain due to sale of an asset or a loss due to sale of an asset. So the standard says that IFRS 16 says that gain or loss, only realized gain can be shown in P&L. What is the realized gain? To the extent what is your sale value, fair value of the sale, minus the ROU cost of the asset, only that element, to that extent gain can be recognized. Unrealized gain, which is the extent to which the ROU cost have been come back to the financial statement, cannot be recognized. And also IFRS 16 very clearly says that the sale have to be recognized as per the IFRS 15. The criteria have to be recognized as per the IFRS 15 very clearly. So these are the risks that we would note down when it comes to the lease contracts. This is the same thing that you can write for your 50-mark question as well, but be very clear and explain it in a much more deeper way that will help you to pass the paper easily. And when it comes to the audit procedures, definitely, as I told you, we need to obtain copies of the lease contract to confirm the details of an agreement if the ROU can be established by lease, the lessee and all those things. You need to recalculate the amounts included in both initial and subsequent measurement of ROU of asset and liabilities. Whether initial measurements and subsequent measurements of ROU of asset and liability can be established, and that have to be recalculated. Conditions relating to the extension or early terminations should be collected from the lease, right? Those conditions should be established with respect to the early termination or the extensions. Verifying that an ROU can either be substituted or controlled by any other party or other than the lessee. Like the asset cannot be substituted or controlled by any other party, and it has to be only by the lessee. That has to be established. Obtaining copies of the draft financial statement to see the level of disclosure, adequacy of the disclosure. Whether the disclosure is appropriate or not should also be clearly checked when it comes to the the lease contract to establish if there is a ROU and a lease liability could be established or not. You have to very clearly check that.